Hey, what's up, world? This is Serge W.D. Haiti, the dreaded CPA, with Serge W.D. Haiti CPA PLLC, where life is good and living is better. So, in this presentation, I'm going to continue on with the subject of estates, trust, and wealth transfer taxes. So, this section of the presentation is talking about distribution deductions. This is something different from individual and business tax returns, where based on the amount and the type of property that's transferred between the trust, the state, to the beneficiaries, there are allowable deductions that can be made. So these deductions are between two types. You have distributable net income and you have regular distributions. And these distributions are deductible against the taxable income for the trust and the estate. It just depends on which type of entity that you have. So for simple trust, the deduction is either between the lesser of the distribution or distributable net income. And I'm going to get into the distributable net income in the next presentation video that I prepare. So for simple trust, it's simple. It's either between the lesser of the distribution or distributable net income. So besides that, you have the trusts and or complex trusts and estates, and it's in between the distributable net income and distributions as well. However, the distributable amount is the lesser between the fair market value of the basis of the property that was distributed or the basis in the property in the hands of the beneficiaries. So if you recall back in the setting up a trust or estate, the simple trust can only distribute current income, whereas a complex trust and a estate, they can distribute accumulated income, and also they can distribute property or the corpus or the principal in those entities. So if any of those properties are distributed, it's going to be the lesser of the fair market value or the basis in the property at the time it is distributed to the beneficiaries. So one of the good things is that complex trust, if you anticipate that income is going to be less in the future years compared to the prior year, you can make distributions within the first 65 days of the tax year and apply that to the previous tax year to use as a tax strategy to reduce your distributable net income. Also with estates, bequests, if they have installments that's going to be made to the beneficiary, those can be excluded from the calculation of income. Also, the fiduciary recognizes no gain on the property. It just depends on how the estate is set up. It could be applied to the property, or it could be applied to the fiduciary account or the trust or the estate. Also, the basis in the distributed property that is transferred is going to be adjusted for any gains that is recognized by the fiduciary. So, for example, if you have a property that's worth $1 million and you end up selling or transferring it over, the fiduciary or the trust or estate has to recognize the gain. So with those gains that's recognized, it's gonna increase the value of the property into the hands of the beneficiary. And those gains are first recognized against distributable net income, or based on how your income or your instrument is set up, or your trust or estate is set up. You can allocate the amounts towards current income, accumulated income, or principal. Or you can have it set up where the principal is distributed tax-free. So this is a little information about distributable deductions that trusts and estates have. If you have any questions, you can leave a comment or your questions in the comment section, and or you can inbox me and we can go over that to clarify any questions that you have regarding this section of the topic. And once again, I'm the dreaded CPA, Serge W.D. Haiti with Serge W.D. Haiti CPA PLLC, where life is good and living is better. Peace.